Hello, everyone, and good afternoon. I'm Faisal Al-Hakim, the Business Development Director here at Han ETF, and I'm pleased to be moderating today's webinar covering COVID-19 and the future of technology, buying opportunities in Megatrend stocks. Thank you to all our listeners for joining. Han ETF is Europe's first and leading white label ETF provider. We work with asset managers from around the world to bring innovative investment exposures to the ETF world. In this webinar, we'll be covering which technologies are seeing an increase in demand and usage. We'll be exploring how additional forms of technology are being embraced by companies, hospitals, and government, everything from cloud computing, AI, robotics, and automation to telemedicine and wearables. We'll also be looking at buying opportunities in Megatrend stocks specifically to see how investors can gain diversified exposure to these tech sectors using a thematic ETF. Now, I'm delighted to be joined by Anthony Ginsberg, who's the Managing Director and CIO at GINS Global, a California-based asset manager that provides index-linked investment products, including ETFs, capital guaranteed funds, and index funds. Anthony Gins is a fund partner of Han ETF, and we launched the Han Gins Global Innovative Technology UCITS ETF together. So before we move on, I just want to set out a few housekeeping notes. So we will have a 10-minute Q&A session at the end of the presentation. So I please ask that you send us your questions throughout the webinar, and we'll do our best to answer them. Please be reminded that listeners are also able to download various content items and links relating to today's webinar in the attachment area below the slide section. The slides will also be made available after the call ends. I would like to now hand over to Mr. Anthony Ginsberg, founder of GINS Global.
Thank you very much, Faisal, for your introduction. Welcome, everybody. We look forward to going through a number of slides talking about the future of tech, and particularly the sub-themes that make up our innovative technologies ETF. At the moment, we actually have 8 sub-themes, of which we're going to focus on 6 today, from cybersecurity, cloud technology, social media, AI, and robotics, genomics as well, which is related to gene editing. So it's a very exciting area, and obviously COVID-19 is playing an important role in a number of these areas. We actually see the novel coronavirus as fast-tracking adoption rates across a number of these sub-themes. So although there's a lot of disruption and hurt out there globally, a number of the companies in our ETF holdings, we have almost close to 100 underlying holdings. A number of them are at the forefront of either vaccine research or other areas that are benefiting from the remote work from home process that's currently underway. So I'm just going to run through a couple of slides, and we're going to take some questions and look forward to your participation. If I can get to the very first slide, which is going to show you just how the fourth industrial revolution is impacting the area of future tech. So our particular ETF is listed in London as well as in Milan and on the Frankfurt Stock Exchange as well. It's available in euros, US dollars, and pound sterling. So if we just look at where we are today and the Industrial Revolution 4.0, the Industrial Revolution 4.0 obviously follows on from the previous revolutions, such as mass production and the original Industrial Revolution back in the mid to late 1800s. This is in particular talking about the digital 4.0 revolution, the slide, and we can see how there are a number of areas from AI, cloud computing, and mobile devices that are all essentially benefiting in one way or another from the interconnectivity, such as the Internet of Things. So whether, if you look at the details on the slide, we've got things such as the Internet of Things platform, we have 3D printing, medical devices, cloud computing. They're all actually interrelated. So what we're going to discuss this afternoon really shouldn't be seen as individual silos. A lot of them do interact, and in many cases, some are even, let's say, first cousins of one another. Areas such as cybersecurity actually interact very closely with cloud computing's growth, and often they benefit from one another's advances. So with that, I'll move on to the next slide and just try and explain that this particular ETF is really a diversified play into the Industrial Revolution 4.0. We're not taking a particular bet on any one of the underlying sub-themes. It's equally weighted across future cars, social media, cloud, cybersecurity, genomics. And I guess the main point of this slide is to show you one goes back 5 or so years to 2014, ITEK, which is really in the turquoise blue there. You can see essentially how it has risen over the period. So the final column there, 2014 to 2019, shows that basically ITEK has consistent performer, and actually over time here has essentially been in the top 3 performers if you compare it to each of the underlying sub-themes. So what we've done is equally weighted all of these sub-themes, and it gets rebalanced semi-annually or twice a year, and we're using a rules-based system developed by Selective. So again, we have essentially 15 underlying holdings per sub-theme, and we have up to 8 sub-themes. At the present time, the sub-theme of virtual reality and blockchain are not filled up. So at this point, we have essentially 90 holdings. We're very close to 91 holdings at the present time, comprising the underlying themes you see there. So I'm going to take you through step by step each one of the sub-themes that contributes. And just to begin with, perhaps one of the fastest growing companies out there, and although it has some controversy, I thought we just touch on Tesla and how an example of future cars also relates to cloud computing. This particular slide relates to a person who has ordered goods online. The gentleman was at work, and it's a true story out of New York where he asked the Amazon driver to stick the parcels in his Tesla car that was left at home in the driveway, and was able to open up the car remotely from his office and have the materials left in the car. Essentially, what Tesla has actually done is connected all their batteries and all their cars via a master cloud system in their headquarters in California. So, for example, when there was the hurricane some months ago in the Florida and Bahamas region, they were able to actually identify those cars and allow those cars to have significantly more battery power. Essentially, they doubled the battery usage or power in those cars and allowed them to have double the driving distance to be able to get out of harm's way. So we don't see Tesla really as just a car company. We see the whole area of future cars as being very technology driven. So just an example. And just to give you an idea of how far ahead Tesla actually is, because although some media reports may put doubt into Tesla's viability, they've actually been able to deliver substantial vehicle sales in terms of their delivery over the last 18 months. And that's why you've really seen a reboot in their share price. Prior to COVID-19, it actually hit a high of just over $900, which surprised many. It did drop back, although it's now recovered a substantial amount of its losses, so well over $700 a share again. That just gives you an example of how the Tesla Model 3 deliveries have picked up substantially. So we are positive that what Tesla is doing is pulling really the rest of the industry along with it. So just to give you another sense of how the industry is doing, this is the list of the top 20 EV or electric vehicles in the world as of the end of 2019. And if you go down the list, you can obviously see Tesla is well ahead, but there are a number of other players, including BMW, Volvo, and others who are getting better positions. So we are positive that the entire industry has made a huge shift. The amount of capital expenditure is significant, and we own a number of underlying companies, including Volkswagen, which has got more than 20 odd models in the EV space coming on stream over the next 2 to 3 years. I thought we'd segue onto this slide, which really shows back in 2019, the percentage of small and medium enterprises that were expecting to close their traditional IT data centers or their IT departments, and how that has shifted, and the expectation by 2025. And what you can basically see is at the time, only about 10% thought that they may close their traditional data centers, and how that has shifted, where at the present moment it seems as though close to 80% of SMMEs in particular, small and medium enterprises, will have outsourced most, if not all, of their traditional data centers. And this has really put a lot of the more nimble small and medium enterprises into a much more flexible process. Over the last couple of weeks in particular, we've seen those enterprises being the quickest to adopt remote working habits and allowing their clients and their staff to be able to access data very easily. It's been, frankly, a much smoother transition for the small and medium enterprise sector, whereas often the largest companies have had some challenges with their legacy systems. And in many cases, they're unable to use third-party cloud providers as much as they would like, partly for regulatory reasons. If they're a bank or an insurance company, often they have their own private cloud that has to interact with a public cloud. But nevertheless, what has happened over the last 2 months globally has made the adoption rates in third-party cloud significant, and really the flexibility of cloud in terms of their subscription models, and the fact that costs can be curtailed. Certainly the maintenance costs of maintaining an ongoing in-house IT department are significantly reduced by outsourcing. I'll just go through a couple of other examples of where the cloud actually fits globally. At the moment, cloud really is divided up into 3 areas. We call them infrastructure as a service, which is really the big plumbing and pipelines that have been developed globally by the likes of Amazon Web Services, Google, and Microsoft Azure. That's really the more expensive capital expenditure. Often it's also interlinked with server farms, and in some cases telecom players as well, 4G and 5G. The platform as a service and software as a service areas is far less capex expensive, and in fact, despite the weakness in the economy projected over the rest of 2020, the companies in the SaaS, the software area, and the platform as a service area are generally not highly leveraged. In fact, we see the tech industry has been one of those that has bounced back the strongest over the last couple of weeks. The reality is that unlike a number of other sectors, the leverage and gearing in this area is quite minimal. We are very excited that software as a service ultimately will expand globally on the backs of the cloud infrastructure. So there are firms that are quite well known. Salesforce is on this at the very top there, you'll see, as well as the likes of SAP, Oracle, and Adobe Acrobat as well, where they're able to roll out their software packages in a much lower cost delivery mechanisms. So whereas some of them may have focused on Fortune 500s or very large enterprises in the past, we actually see those companies benefiting from far cheaper delivery systems, and it will allow small and medium enterprises to also benefit. So we see significant growth in the software and platform as a service areas within cloud. And this slide really just summarizes it. You'll see over the next 3 to 4 years, in green and blue, the faster growing areas include software as a service as well as platform as a service. The other areas covered here is the infrastructure area and cloud security as well. But in general, the entire industry is expected to double over the next 4 years. And the compound annual growth rates have been very impressive, of the order of anywhere between 20 to 30% for these underlying individual categories. I think it's worth just mentioning before we jump to the next slide that the cloud area has certainly benefited in IT budgets. So although there has been, obviously, given the current economic crisis, a cutback in technology expenditure, it hasn't really been felt in the cloud space. We've actually noticed that hardware and other more expensive purchases have suffered, and IT budgets have essentially shifted to this outsourcing model of the cloud as far as possible. And the subscription model, again, which is really almost like a rental or a leasing process, where one can actually pay a monthly fee. You can adapt or change your monthly contract. In some cases as well, there's flexibility to upscale or upgrade the amount of usage that you may need from time to time. It's just the flexibility at the moment that cloud offers, and the reduction in maintenance cost is a significant no-brainer for many companies to make that leap. So I wanted to shift to the medical space, in particular remote medical technology such as telemedicine and even AI diagnostics. Obviously, with regard to social distancing, a number of doctors and health services, including the NHS in the UK, have encouraged the adoption rate of remote medical devices, and also obviously the use of consultations remotely. So there are a number of companies in our ETF that are benefiting from this, from the very largest firms like Medtronic, which is a large-scale medical device firm, to smaller groups that are either in robotic surgeries and also in deliveries to intensive care units, allowing the remote interaction with healthcare professionals. So there are a number of areas here, everything from pulse monitors to medical wearables to other smart devices. We're certainly seeing a much faster adoption rate. A number of these areas existed prior to COVID-19, but were seen possibly as a luxury and were not adopted at the time as mainstream devices. So obviously there's been a huge sea change. We see a lot more expenditure planned now in this area and the space. So we feel that the healthcare technology and also gene editing have been propelled and boosted forward. Just in the case of gene editing, a number of the vaccine players at the very forefront of trying to find a COVID-19 vaccine are in fact part of our genomics theme. So in our case, genomics covers such areas as CRISPR, gene editing, and there are also some biotech firms in there as well. Firms like Regeneron are one of those leading the charge in the vaccine race to find a cure. I just wanted to also just give you an example of how telemedicine and telehealth work. Essentially, it allows not just one-on-one consultations with doctors, but also allows the monitoring of ventilators and ICU equipment by medical professionals who don't have to actually be physically in the room. So I think it's very important that it's really allowing certain ICU units that may have 60, 70 beds to actually be monitored remotely and to be able to, make sure that the different levels of service are maintained, even though it may be from a distance. The next slide talks about the applications of AI in healthcare, and there are a number of areas, as you can see, from diagnosis and treatment all the way through to mobile apps and even virtual assistants. Just something that may not be common knowledge in Europe, but out of the US and Canada, some states and provinces over here in North America were able to be notified well ahead of time about hotspots or the spread of the coronavirus through the use of AI modeling. There are a number of examples. The state of California in particular was able to use Blue Dot and other AI services that monitored incoming flights from China and other trends in terms of the outbreak, where particular hotspots were identified or certain hospitals that were going to be overrun could actually be predicted fairly accurately by artificial intelligence software. It's become an increasingly important use by the public health system and in particular in the US by governors here to try and understand which regions of their states and perhaps which cities were more likely to see a huge increase. It also allows them to monitor social distancing and to see which areas allow for more movement. So it's already been helpful in terms of tracking. And again, it's done anonymously, so I know there are privacy concerns about some of this. But certainly places like California, New York, the cities of Toronto have felt that they had an inside track in some cases. I know New York has suffered significantly, but there are other places that have used the software as wonderful predictors of where the outbreak was most likely to be found next and where they were seeing spikes almost ahead of time in some cases. Because there's predictability. So we see a big uptick in AI healthcare. Another example of AI diagnostics is in the area of machine learning, where patients are coming into hospitals, such as with the NHS having adopted for their eye hospital, a very famous eye hospital called Moorfields out of London, central London, where before ever seeing a specialist doctor, patients go through a medical screening with actually a computer that DeepMind of Google helped develop to screen corneas and retina eyes examinations so that it helps speed up the consultation process. I did touch briefly on the medical wearables market, and certainly with the outbreak, you've seen an even bigger uptick in people having bracelets, but this refers essentially to areas such as Fitbit and others. You may recently be aware that Fitbit, even though it was not hugely profit-making or profitable, it was purchased by Google for roughly $2.5 billion. And the expectation is that more medical devices and wearables will become mainstream increasingly through the likes of bracelets and Apple Watch. In fact, Tim Cook of Apple believes that his legacy will not be the iPhone, but will actually be Apple's move into the healthcare space. And we've actually seen that with some of the other big tech players, such as Amazon and Google, who are buying up patient records and offering, whether it's AI diagnostics or other areas where they can assist in medical administration. In the US, unfortunately, there isn't a national system. So if someone gets sick in a particular state such as California, but they happen to live in Florida or New York, it can be rather difficult for the data to be shared. So we see big tech really moving into the wearable devices market in a big way. So it's an exciting area. And obviously with such challenges in the US, such as diabetes, blood sugar levels, and pulse levels can be very easily monitored through wearable devices. So we expect a bigger uptick in the space going forward. I wanted to shift gears and talk about the cybersecurity challenge. Every time there's been a major hack attack or loss of data, we've seen not just the cybersecurity companies benefiting, but we've also seen cloud computing benefited. Now, I thought I would show you two particular charts here. One is the annual cost of data breaches going back to 2017. And you can see it's basically grown almost threefold in the cost of data breaches on the left-hand side. The right-hand chart is actually showing the congruent annual cybersecurity spending over that period, and that's also growing fairly substantially, not as fast, but it's expected to also double. And as the outsourcing use of cloud predominates, there is a pickup also in cybersecurity. So there are a number of interesting features here. There are cyber companies that are very closely linked to cloud companies, and there are a number of cloud firms actually that have cybersecurity units, including the likes of Microsoft, Azure, and even Google and Amazon Web Services. So it's fairly closely aligned that cybersecurity and cloud interact closely. And we do see an increasing use in cybersecurity. We have 15 underlying holdings in this space, and obviously the main players do focus on corporate cybersecurity. I'll just mention as an aside that when Hollywood was hacked some years ago, as well as BA, we saw a significant uptick in the usage of Hollywood studios and airlines following those hacks. And that has continued to be the case. A number of the players here in California, where I'm based, have said, look, we're not in the business of hiring software engineers any longer. Yes, we'll have a couple on staff, but the more we can rely on big players to assist us. So there's been a staffing up, certainly across both big and smaller tech players. It's also worth mentioning that there are software companies such as the likes of Salesforce that do provide their own cybersecurity for third-party clients. So with that, I thought I'd just show you the growth in the cybersecurity market overall. It's essentially doubling at the moment every 5 to 6 years, but we see this number actually being spurred on based on COVID-19 as well. So the chances are that these numbers for 2025 are actually understated at the moment. If one just divides the cloud space itself, at the moment Amazon has been the leader, particularly in the infrastructure space. But it's worth mentioning that Google and Microsoft are actually growing currently faster. So although their market shares are, in Microsoft's case, only 16% and Amazon's at 33%, Google is growing significantly faster for a lower base, certainly. And also what's important is that the likes of IBM have essentially moved into an area of cloud called a hybrid cloud, where their main focus, they spent $35 billion just in the last 18 months buying a hybrid cloud player called Red Hat. It was the biggest acquisition in IBM's history, and the idea is to allow the usage of data and the transference of data across multiple clouds. Up until now, one of the areas that held cloud back in terms of mainstream adoption, beyond just outsourcing the simple administration tasks or certain email, has been the sharing of data between multiple cloud platforms. That now has moved on with open source software. So in the case of Red Hat, they use Linux open source software. They're able to move data between both public and private clouds. And I referred much earlier to the banks and insurance companies and highly regulated entities that will always have to require a private cloud. Unlike the likes of Netflix or Airbnb, they will most likely always have to keep substantial data on an in-house private cloud. But increasingly, they're able to at least shift some of their middle office functions as well now to third-party cloud providers. So we do see big money center banks, insurers, and other regulated entities being able to move some more of their data to third parties to save ongoing costs. So even the likes of Salesforce and in China, of course, Alibaba, Tencent, Baidu are also essentially copying what Amazon has done in the US by getting to dominate the Chinese market. It's essentially dominated by those three players. Here in the States, to summarize, the likes of Salesforce and Oracle and SAP in Europe are piggybacking on some of the very big cloud infrastructures provided by big tech. And this just shows you the growth of Amazon Web Services in particular. They actually now represent, while sales is still under 20% of all of Amazon's global sales, if one actually looks at the profitability of Amazon as a business, close to 55% of their latest quarterly earnings over the last 2 quarters are represented by their cloud division. And interestingly, the likes of Google and others are now breaking out their cloud numbers, and we actually see significant expenditure there. We really see cloud as the current big tech battleground, and we see more potential for M&A activity. Gartner, a leading researcher, just came out with statistics showing 60% of all IT expenditure over the next 3 years is expected to be specifically in the cloud space. I just have 1 or 2 other quick slides just to give you a relative size of robotics versus cloud. In Europe, there are some robotic products or funds, and cloud products have been relatively new to come through. We're happy that our ITEK innovative tech ETF includes cloud, because it has been a newer area to be offered to European investors in particular. And I think with that, Faisal, I'll turn it over to you. I'm very happy to take a couple of questions and appreciate everybody's time this afternoon.
Thank you very much, Anthony, for an excellent presentation. That was really insightful. So we can now move on to some of the questions. I will just remind our audience that they can enter questions just below the slide area, and presentation material from today will be made available after the webinar ends. I'm going to give the audience 1 more moment to put through their questions, and if you do have any other questions after the webinar ends, you can of course email us at info@hanetf.com. Okay, so the first question we've got is, Anthony, which theme do you think will benefit the most from COVID-19?
Yes, one of the themes that I didn't really touch on much is social media. We've seen an increase in social media with people working remotely and friends not being able to, physically be together. We've actually seen an increase. So we actually do see social media benefiting from increased advertising, but certainly the genomics or healthcare tech side in the short term is certainly going to get a lot more public commitments, more public budgets. Government budgets are heading in that direction. I guess that some of the delays that we saw previously in healthcare spending, certainly the reins have been loosened in that area. So we're very positive in the healthcare technology space. Another area that we see benefiting are these gene editing companies, particularly we call it genomics, which really covers such areas as CRISPR and trying to provide low-cost personalized medicine and also remote medicine. So a number of those areas are certainly amongst the leading lights of our beneficiaries. And it's just an area that doesn't get as much coverage, perhaps, is the area of AI and robotics. And I think the important point there is that there is a lower cost delivery mechanism available in the medical community that hasn't been utilized as much previously. We think that work habits for doctors will begin to change. Not as many will need to go into the hospital or require their patients to necessarily visit the hospitals going forward. So that's another area. And just lastly, cloud has certainly seen a big uptick in demand. So particularly amongst small and medium-sized enterprises, increasingly the outsourcing of IT infrastructure, that adoption rate is certainly set to continue. Thanks for the question.
Thank you, Anthony. We have a couple more questions. Does a lot of the healthcare theme rely on cloud computing?
Okay, it's a good question. The answer is increasingly yes. We've got firms, even a well-known group in the healthcare space, Celgene, that does various vaccine trials. They've been using cloud computing actually to speed up receiving data from global trials. They can actually receive the data via cloud. They can get their researchers to input the data online. So that's just an example. But the other area that obviously we see cloud and medical tech interacting with is in the diagnostic space, and also in the consultations where doctors obviously can have video conferencing facilities. They're able to also use pulse meters and other data detection mechanisms such as these medical wearables, and that all relies on the Internet of Things, or let's call it the cloud. So as Apple Watches and Fitbits and the like continue, and medical bracelets continue to be adopted and become a way of life, certainly in the US, where we have a separate explosion in diabetes patients here, and huge cost savings to medical services and to governments if they're able to monitor their customers and their patients remotely. So yes, particularly in wearables, it's highly reliant on cloud. It's a very good question. Thank you.
Next question. With so much changing so quickly and so profoundly, what are the benefits of using an ETF such as ITEK to get exposure to all these emerging technologies in a post-COVID world? And does ITEK specifically offer exposure to small and mid-cap stocks?
Yes, it's another good question. So we found it quite bewildering for many investors to get exposure beyond the FANGs, the couple of big tech players, and frankly beyond some of the very large cap benchmarks such as the NASDAQ in tech. And many investors have actually potentially missed out on these themes such as AI and robotics, because they just don't form part of some of the bigger tech players' mainstream businesses. So the answer is we do drill down to mid-cap and smaller cap players. As I mentioned, we have close to 100 underlying holdings. And although there are a couple of big players in there, everybody's equally weighted at around 1.5%. And it's rebalanced every 6 months. So you're getting a very broad swath across all of these 8 sub-themes. And again, we haven't made a particular bet on one sub-theme versus another. So we see ITEK actually fitting inside of a portfolio as a very conservative play across the global tech revolution of 4.0. And yes, while we have some big heavyweights from Silicon Valley, that's a lot broader than that. And I think what we're most proud of is that we allow people to have equal exposure to social media, future costs, cybersecurity, cloud, healthcare, genomics. And we're saying, admittedly, we are not taking a particular bet on one sub-theme outperforming another. If one does have a good run for 6 months, it gets rebalanced back into an equal weighting. So at this point in time, having close to 100 underlying holdings, I think, does provide a lot more diversity. And we've seen significant returns that actually recovered remarkably well just in the last month of April. Everybody, of course, globally suffered during the March downturn, but ITEK has bounced back very strongly and has basically recovered almost all its weakness that it experienced during March. It's basically almost close to being flat for the year 2020.
Thank you, Anthony. I did notice that the ITEK ETF was outperforming the S&P 500 by some 7.5% year to date, so that really puts it into context. Another question we have from our viewers, would this be a better time to get into broad tech, or should we be thinking of a more targeted approach?
Yeah, it's also a good question. We've actually seen with the run-up in big tech companies that a number of client portfolios and investor portfolios is very, very narrowly focused. And we've tried very hard to say, hang on, there's a much safer, broader way to actually play the technology revolution. There are a lot of undervalued companies in the mid-cap space and even in the small-cap space that more than likely will be the subjects of M&A. For example, one of our holdings was Red Hat and in the cloud space, and it was acquired by IBM. And when that happened, Red Hat more than doubled overnight. That actually helped propel our ETFs. So I think the point really is some of the bigger tech companies are arguably a lot more fully priced, and we've still seen lots of value left on the table amongst, let's say, the other 80 or so holdings that we have in our ETF. So for us, the whole idea is to not overweight the big players and to provide really a broad exposure. Again, we see, if you just look at PE ratios, earnings per share, the valuation multiples below the 5 or 10 most famous mega caps, it certainly drops off, and there's a lot more upside, in our opinion, both in the acquisition space, but just in valuations in general, bit below the top 10. And just interestingly, this is a global ETF. So although the US has roughly a 65% weighting at the moment in this ETF, over time we expect it to possibly reduce closer to 60%. China certainly coming up. We also have some European holdings that have also grown recently. So just to summarize, in our opinion, it's a global market, and we do believe that there are some of those innovative players are not in the top 5 or 10 big tech names, and that's partly why we've designed this approach to be much more broad scaled.
Thank you, Anthony. I think it's clear for everyone to see that COVID-19 has really brought working from home technologies and other emerging technologies to the forefront of our daily lives, the way we interact, the way we work, and this is sort of profoundly changing investor attitudes. Do you think COVID-19 will accelerate the man working with machine idea and the Industry 4.0 concept?
Yes, absolutely. We actually see what's happened over the last couple of months as really a boosting demand and the adoption rates in particular as a way for companies to really protect themselves. So we see it as almost a prudent approach that boards of directors of companies will increasingly adopt a number of these areas in terms of the Industrial Revolution 4.0. And that's partly why our methodology, just the slide I put up there, essentially has said, look, we were equally weighting across these areas because we believe people are most likely now to adopt areas such as future cars, cloud, cybersecurity, genomic, medical technology. And they're going to be embracing it a lot more so than in previous years. So the answer really is, if anything, despite all the negativity we read and hear about in the coronavirus space, this epidemic is actually shifting people's habits to adopt more technology and to embrace usage. I think many people who may have been a bit scared or a bit reticent to use video conferencing and would have rather jumped on a plane and gone and met face-to-face, I think this is being reset. And we don't think habits are going to revert back that easily to say, let's say 2019 levels. We see less travel occurring. We see medical services and healthcare providers increasingly adopting these techniques to save them costs. Obviously, there's a huge challenge in the industrialized world with older populations, with the pre-existing conditions. And if they're able to use monitoring devices and medical wearables and embrace these areas, it will actually save them billions of dollars. So we see the NHS and other healthcare providers actually embracing this even more so. So we're very positive that a number of gear-changing events have actually occurred over the last couple of months, which will spur larger budgeting in the space, both in the IT area specifically, but also in healthcare technology. Thanks, Faisal.
Thank you, Anthony. I'm obviously conscious of time, but we have a few really good questions left. So I'm going to put them to you, Anthony, and hopefully we can try to wrap this up in the next couple of minutes. So the first one is related to another emerging trend, which is ESG and SRI and sustainable investing. Is there any positive ESG and or CSR influences to be expected in these sectors after COVID-19?
Yes, I think actually there's many of the big companies are under pressure to adopt ESG and SRI processes and protocols. So the quicker answer is yes, indeed. It's easier for some of the larger players in our holdings to do that. But even the small and medium enterprises, we've heard from their executives that they all want to offer ESG compliant processes. And I think many people recognize that if they aren't optimizing their ESG areas, that they may ultimately be discriminated against by investors. So that there is an underlying push to be ESG compliant. So the short answer is absolutely it does affect big technology and all of these sub-themes. Those players are all well aware of it. And I think partly because many of them are based in the US, they're based in California. There's certainly a strong focus on being ESG compliant.
Thank you, Anthony. The next question is, this ETF seems to go beyond the FANGs and dives deep into disruptive and megatrend tech stocks. Is this a good ETF to have as additional exposure to a broader tech exposure?
Yes, well, I think the short answer there is that we're drilling down into such areas as social media and AI, robotics, cybersecurity, areas that typically in a NASDAQ 100 or even an MSCI tech type of index will be significantly small and may actually barely provide any exposure at all. So I think what we've seen is tech, unfortunately, has been dominated by a couple of large FANG players, and in some cases, those benchmarks I referred to earlier may represent half of the benchmark may be represented by 5, 6, 7 players. So it's rather risky, and we recognize that there are investors in Europe and the UK and elsewhere that we service with this ETF that really want a broader approach and don't want to necessarily be overweight just 5 or 6 or 7 players and be significantly exposed just to their goings on. So the bottom line for us is by broadening it out to close to 100 underlying holdings and really equally weighting and giving everybody equal airtime, as I showed in one of those earlier slides, it's very tricky to just bet on 1 or 2 sub-themes. We found that by equally weighting all of these 8 underlying themes, it reduces the risk and really allows some of the smaller plays in some of these other areas, such as robotics and AI, to be given equal airtime. And in any one given year, yes, there'll be certain sub-themes that outperform. But by equally weighting and rebalancing it twice annually, over the last 5 years, we've actually seen ITEK essentially be in the top 3 performers out of all these underlying themes. Ultimately, it rises to be an above average performer. And again, it reduces the risk of any one particular theme or just 5 or 6 very large mega stocks. We actually see the antitrust challenges in the US potentially impacting the FANGs. They're not able to potentially grow as fast. It's the law of big numbers for them. So we see the faster growing companies being really the next level down in the mid cap and even in certain large cap space, but below the mega cap size.
Thank you, Anthony. I think that's really great how you've illuminated on the diversification benefits. I think what's clear is that there's so many young companies and companies that have been around but which we haven't really embraced individually, such as Zoom and Slack. And it's clear there's going to be more of these companies that go mainstream, and having a well-diversified ETF offers a fantastic way to get that small and mid-cap and large-cap exposure in a way that you wouldn't ordinarily be able to do with a core ETF or building block in a portfolio. One final question for you, Anthony. Can you illuminate on the market's ability to forecast earnings of these big tech companies in the face of the COVID crisis?
Yeah, well, that's a very tough question. I think many of them have realized that they have to be very careful, so they've scaled back on their earnings projections. And in fact, many of us, this is an important week because the earnings are going to be coming out for the first quarter across a number of the large Silicon Valley players. So it's going to be an interesting time. A number of them have rebounded strongly, but the typical earnings forecasts that analysts are used to receiving for the moment have partly gone out the window. So it's actually very tricky. And many people believe that certainly the first and second quarter numbers may not be wonderful, may not be great indicators. The main thing people are looking for, particularly when it comes to such companies as cloud and even in social media, is the level of advertising in social media. Has that continued at a regular pace? And also in terms of cloud, have the subscription numbers grown, and are they continuing? So even though there may be some short-term pain, people who are on this regular annuitized sort of revenue model, those firms are being best rewarded because they're the ones who are basically maintaining steady earnings and ongoing revenues regardless of cycles that we've just been through. So I think the short answer is there is certainly uncertainty in big tech earnings, but those firms that are being most rewarded at the present time are those who have adopted more of a subscription-based model where their earnings are much more regular, and we don't experience these wild swings. So there's increasingly firms such as Salesforce, such as Adobe, Adobe's market value has doubled in a very short period of time. They've actually overtaken the likes of both SAP and Oracle in market cap, which has been amazing. Most of us just know Adobe in terms of their Acrobat program, but they offer other services well beyond that. And a lot of it is linked to them initially sacrificing some upfront earnings in lieu of rather building a subscription-based model. And that is now being significantly rewarded. And as I said, they've overtaken some leading stalwarts. And Salesforce is another case that they've become more valuable actually than Oracle. And the founder of Salesforce is actually a refugee really from Oracle. So it's very, very interesting times. I would say those are the companies that are being best rewarded, those who've got stable earnings and have built an increasingly subscription-based model.
Thank you, Anthony. Well, I think that really makes you think about how difficult it is to value these growth companies, and again reminds us of the benefits of taking a well-diversified approach to investing in such companies. I wish to now thank you very much, Anthony, as our presenter today, and I would also like to thank our listeners for dialing in. And I would like to remind you all that today's webinar slides will be available after the webinar ends. And we do thank you for taking the time to rate our webinar with a 5-star rating if possible. And please be sure to subscribe to the Han ETF Bright Talk channel to be notified of more of our upcoming webinars. And we look forward to having you join us for our future webinars. I want to thank you all and wish you a good afternoon.
Thank you.